The final thing on today's formal panel is our discussion of growth and value. I've got a panel of 5 people led by Mr. Tim Koller. You heard Tim a minute ago. He asked a question. Tim is a principal in the corporate finance practice at McKinsey & Company, which I think everybody knows, either the largest or among the very largest of the world's consulting firms. Tim has 28 years of consulting experience, principally in the corporate finance area. His particular expertise and his particular interest is on the link between value creation, corporate strategy, and the capital markets. He's written 2 books. One of them people may know from their school days, which was, that for you, that's helpful, is Evaluation, which discusses all the different ways and the implications of different ways of placing values on companies, projects, cash flows, and almost anything. The most recent is somewhat more philosophical, called Value, and is intended to talk with very senior managers about the issues, philosophy, and imperatives of value creation. I'm going to turn the floor over to Tim, who will introduce the rest of the panel, and I guess that's all I have to say.
Thank you, Paul. Thank you, Paul. Actually, I've known Paul for those 28 years because we worked together before I joined McKinsey. So thank you for having us. I'd like to, why don't you guys sit down? I'd like to introduce the panelists here. David Lenzmeier. David is CEO of Milk Specialties, one of the largest providers of high-quality milk and whey proteins nationwide, privately held company. David's previous roles have been with First District and protein part of the business, which he co-founded. He has been with, he's grown Milk Specialties from 4 to 10 locations and almost tripled revenues to $700 million. Thank you. Second panelist here is Mick Morn. Mick is head of Louis Dreyfus Commodities, the North American region. Louis Dreyfus Commodities, for those of you who don't know, is a global merchandiser and processor of commodities, everything from oil seeds, grains, feed, finance, cotton, fertilizers, inputs. He's been with Dreyfus since 1997, spending most of his time in the cotton and energy operations. And he served Dreyfus in the US, Paraguay, Belgium, Asia, country CEO for China, and now he leads the North American region since 2011. And then we have Brian, right? Brian is the CEO of Bay State Milling Company. Bay State is based in Quincy outside of Boston. Family-held company, one of the largest specialty millers in the U.S. with 9 locations around the world. Leading positions in whole grains, durum, rye, organic flours, and following a recent acquisition, it will be a leading miller and supplier of ancient grains, edible seeds, and sweet spices. I think that the ancient grains are not necessarily that they're actually been in the ground that long, they just are from a long time ago, the origin, I presume. And then finally, Mr. Brian joined Bay State in 1975, has had various positions in sales, administration, and CFO, as well as now the CEO. And then finally, at the very end, Ray Dillon. Ray is president and CEO of Deltic Timber Corporation. Deltic, based in El Dorado, Texas, focuses on owning and managing timberlands, is vertically integrated with solid wood and product operations. He started his career in production and operations with Count Zellerbach in Louisiana, and moved through a number of senior management roles at both, at Gaylord Container, which was one of the predecessors of Crown Zellerbach and Crown Zellerbach. He joined Deltic as CEO, Deltic Timber and CEO in 2003. So thank you all very much. Please have a seat. Okay, the topic today we're going to talk about is about value creation. As Paul mentioned, it's something that I spend a lot of my time talking about. It's a difficult topic. It's come up condensed in a number of the conversations we've had so far. Rosbeth mentioned it in terms of the sort of debates around shareholder value. It's certainly an important component of growth. But lately it's been under attack, and partly because I think there's a lot of confusion about what value creation is. And so there's three things I would like to sort of have us talk about today. One is a little bit about how different companies think about value creation, the trade-offs between growth and profitability, or growth and return on capital, two important elements of value creation. One of the advantages we have here today is the different representatives here have different ownership structures. One is a listed company, one is a family company, one is a privately held company, one is a division of a much bigger company, which is also, I think, probably family controlled. And then I'd also like to talk about the issue, we'd also like to talk about a little bit about one of the topics that we've been hearing about, which is sustainability and value creation, and how those can go hand in hand. So let me just start real quickly with the question about how do you think about value? How do you make trade-offs? In particular, when you have a trade-off to be made in terms of value, what are some of the hardest trade-offs you've had to make, or hardest decisions in terms of value creation, and how did you make that decision? And why don't we start off with David, please.
Okay. So, I think I've been, over my career, been involved in different ownership structures, from cooperative to private equity, and I think as we try to assess the value, I'll use a cooperative as an example, that we're looking for long-term market sustainability for different shareholders. But we try to look at it from a private equity perspective. You have to be very cognizant of the time frame, the size of investments that we're going to take into consideration within the window of the ownership group and the outlook. So we have to balance the two of them. There's certain investments I know that we can get excited about that really wouldn't fit a window from a private equity group, but certainly would from a cooperative standpoint. So I think, from the experience that I've had, we try to have to balance the two of them. But then getting back to the investment itself is making sure that we can sustain the growth, making sure we can sustain the margin generation, make sure it fits within the window of what we are. For us, we've been big in nutritional ingredients. We're not going to step into an area, say we're going to be in beef production per se, but being very well focused on the markets that fit where we're at, and making sure that we can sustain the value that we're going to create.
Being owned by a private equity firm, how does that color the way you think about these? What are the time frames that you're able to operate under? Those kind of things.
Well, I think it just really helps you hone in your focus on where your investments are going to be. Again, I go back to, we've seen some great opportunities from global partners that want to build milk powder plants. Those probably aren't investments that fit with where we want to be. We need to be very focused on the type of ROIs, the type of timelines that we're trying to meet. So I think it really enhances the focus, which I don't think that's unique to us. That a lot of businesses are going to face those. What are the ROIs? What's the payback on our capital? But we know that when you're going to recapitalize at some very clear point in time, that you have to pay very close attention to what decisions you're going to make on your investments.
Let me turn to Brian. Brian, you're the fourth generation leader of the company. How would you sort of think about sort of value creation from a family-owned company perspective? What are the hard choices you have to make? How do you make those choices? What is the time frame that you think about?
Yes, we're, I think, informed by our private nature, obviously. And it's never been for us necessarily about growth for growth's sake. Our heritage, unlike many other players in our space who primarily came up as merchandisers, we came up as brokers representing our customer. So we think that way. We think about value, how to add value to that customer. And we think that from that perspective, using that wisely and coming up with new innovative products, answering the questions of what they want, listening very hard to what their needs are now and in the future, it gives us the ability to look for value. And in so doing, I believe that it differentiates us and creates our own growth. That notion was put to test in our industry, which got consolidated again over the last year. And we had a chance to participate in a big growth opportunity by capturing some additional market share, but it was in a low or slow growth environment. And we made the decision quite easily that we thought the value of looking at newer markets that were growing over time would add a lot more value to our bottom line. So just a good indication from our perspective of the difference.
Ray, as the CEO of a listed public company, do you have a different perspective? How do you think about those things? How do you deal with the public shareholders?
Well, from a value standpoint, most of the time it depends on what did you buy it for. That's where most of the value is created, possibly. Or if it's an investment, what was the real investment versus what was projected? And do the forecast, are they real? Are they deliverable? And there's a lot of equations that affect all of those things.
And do you feel constrained in terms of your time horizon because of being a listed company, or is that something that you're able to sort of have a longer term focus?
That's a great question, because whether time's your friend or your enemy makes a difference. And, you know, time covers a lot of sins.
Okay.
And mistakes.
Okay. Mick, you've got a very complex business in terms of just the volume of things going on with, large sort of amount of activity flowing through the business with, fairly narrow margins because of the nature of the business. How do you think about those issues, and how do you think about the investments that you're making and what you expect out of them and what the time frame is?
We are indeed a very diversified business with 13 different divisions aligned along commodity lines and very geographically dispersed as well, and it does raise that balance and that sometimes inherent conflict with one of the topics from the earlier discussion, which is how, what is the right growth rate, what's the ambition in terms of size, and are you actually creating value by, achieving a leadership position while not becoming perceived as dominant. So it's an aim of each of our divisions to aim to be in a leading position, but not reach that, stage of being too much perceived as dominant. We have what I would call now a little bit of a hybrid ownership and governance model, in that we are a privately held company for 163 years. It does give us a very long-term view. The main shareholder has a very long-term view, and that is represented in our business perspective and in our way to go through strategies. It does allow us a bit of flexibility, clearly, to the paths that we take, perhaps relative to some more publicly owned type structures. But that said, we have also issued bonds which have certain disclosure requirements, and therefore financials are out in the public eye as well. So it is, yes, a complex business, and many questions to consider with respect to achieving the right balance.
Thank you. As you, and I'll ask you each about this question, as you think about sort of the parameters of sort of, one of the things that we've discovered recently, we've done some surveys of executives, right? And we have found that a lot of executives think, and these are sort of second and third tier executives, not necessarily the top of the company, that their companies are underinvesting, they aren't long-term oriented enough in some cases. We also see other companies that sometimes particularly take big projects on without sort of really thinking about the risks. So on the one hand, We've got situations where we see companies taking on risks that they're not really thinking about, maybe in big risks. On the other hand, we see that companies are sometimes a little bit too risk averse. Or at least that's the perception of their employees, that they're too risk averse, not agile enough in terms of, how do you balance sort of the risk taking? How do you encourage your employees to come up with ideas that will create value and grow while balancing sort of the broader needs of the company? Let me start with Ray down at the end there.
Well, you want to encourage creativity. You want to encourage a certain amount of risk taking, but you don't want a fatal flaw to blow a hole in the boat. And so balancing that's very, very, quite frankly, challenging, to where you want people to take risk, but you don't want them to take too much risk, and having the individuals understand their scope of risk is one of the biggest challenges, and comes with culture and communications.
Mick, you want to try that with your
Yeah,
the size of the number of employees you have?
I think it is an organizational question. Again, coming back to one of the previous topics, how do you avoid the diseconomies of scale? And one thing, as we've grown quite rapidly over the past 8 or 9 years in particular, we have struggled with achieving the right balance of discipline and that sort of public readiness that we've had as a motto for some time, and in terms of risk management and having the right profile in front of our various stakeholders, but also encouraging and fostering and creativity among our people. We've found certainly that having decision-making bodies and authority in reasonable sized components here in North America, as one example, we're about 2,200 people, and having certain decision-making authority to make investments, take decisions, make divestments up to a certain level has worked quite well. As we've become more confident as a group, we've gradually raised these in order to reward good behavior and good decision-making and initiative. So that's structurally a bit how we've looked at it.
Okay. Brian, how would you perspective? How do you encourage employees to be, risk takers, but at the same time, sort of be cautious of the overall sort of risk of the whole company?
Yes, I think we're again a little bit different. Being privately held, but in the sense that some of our banker friends won't let us go too far out on that plank and take undue risk. But it goes back to one of the things Dr. Cantor was saying. I think it's about culture. And we have had a culture over 115 years of prudent risk-taking. And it's sort of become the norm for us. We're not afraid to fail because God knows we've had more than a few, but I think from those particular failures, we've had many, many more opportunities come our way. In terms of reinvesting, we are a capital-intensive business. We can't get away from that, and we've got to take care of the core of that. We have those trade-offs with our shareholders about how much is enough, like anybody here. But there's a certain understanding that we've got to protect our core, because that becomes the bank for us at the end of the day to venture out into some different spaces. So it's a delicate balance, but with the constraints built in because of our structure.
Okay. David, from the private equity ownership perspective.
I was wondering, maybe you might have surveyed some of our executives about not expending enough capital, so they might have participated in that. But similar to Brian, we've got a capital-intense business. I think we've got in the dairy industry, there's some real long legacy businesses that are family held, that you'll see them make some major capital investments, and we've got to be clear that we identify the ones that meet our investment hurdles or horizons. So we go through that same rationalization. I think the big thing that we just try to emphasize is that we get, I think the point was made earlier about what was the assumptions going in, and did we achieve that additional output? Did we achieve those additional markets we expected to? So I think from our plan, our strategy is to make sure we incorporate a broad group of people in those capital decisions, so it isn't a pet project. It isn't somebody doesn't fall in love with a specific project. It still comes back to a return. And we just try to do that broadly so that we've got all aspects of our team looking at these investments and questioning whether they are truly going to be the right ones.
As a private equity held company, how do you feel, and private equity's often been criticized for just levering up companies and not focusing on the operations, but we found a lot of private equity firms are focused on sort of helping to improve the company, helping it to grow. What's your experience working with private equity?
So, this is probably it's a third different private equity group that I've worked with, and I think as a management team, it's your responsibility. We've gone through recapitalization processes before, and people are going to ask, well, you got to find the right fit, you got to find the right partner. I think as a professional group and as a management team, you got to learn to communicate the challenges, you got to learn to communicate the opportunities, and I think when everybody is presented with those facts and they're presented with the right numbers, everybody's going to get led to the right decision. So I think as a management group and as a leader, you got to figure out a way to connect with each person, just like you have to connect with people within your organization. I think inherently people in this room, that's what we're here to do. That's what we're supposed to do it responsibly. But I think that's your job to try to bring those messages across. And the questions that they should ask would be the same questions that our banker is going to ask, or whether it's dealing with Rabobank or whether it's dealing in a private company, you're going to want to take those same metrics to make great decisions.
Did you want to comment on that?
I just had a question for David. You mentioned the idea of broad participation in the decision-making process. There's also that balance there. What's an effective forum, do you think, for reaching some of your most critical decisions?
I think that's a great question. We've got making sure that we're not making specific capital investments without a quality leadership. One of the things we're very proud of in our organization is our commitment to safety. So we're not making some capital investments where we're not bringing our safety leadership into the room to say, hey, are we thinking of everything as we're making some of those investments versus getting 50% into the project and saying, we forgot something here. Yeah.
Any other reactions? Let me ask a question in terms of what's going to this concept of value. One of the key components of value creation is, we've been talking a lot about growth, but the other component is return on capital. When you make investments, you have to earn an adequate return on that investment. Do you have explicit, you don't have to share with us the numbers, but do you have explicit targets? How do you think about that? How do you communicate that in the organization? Mick, would you want to start with that?
We don't have explicit targets. We have, because of the nature of our business, an approach to see the business as a whole. As you would expect with, as an example, building a processing plant or a logistics asset, the asset itself has a certain return. The inputs in terms of the trading in and around those, the origination has a certain return, and the output side has a certain return depending on how the margins and the geography that it gets sold and distributed to. So we take a pretty comprehensive view of what that eventual return on the incremental capital that is deployed.
Others?
We measure return. We measure return on capital employed, and the hurdle rate is our weighted average cost of capital, and we don't feel like we're creating value unless we're exceeding it. Mm-hmm. So it's very straightforward.
Very straightforward. Do you want to do you set a target above that cost of capital? A lot of companies I know sort of set a hurdle rate a little bit above their cost, somewhat above their cost of capital.
I would characterize it as the margin for error. It's
Yes.
what we set above it. It's the margin for error, because all your assumptions aren't going to be correct, and nothing ever comes true like it's supposed to. So.
Okay. Brian, do you have a?
Yeah, we're very much like Ray in the sense that at a minimum we're going to invest obviously over our hurdle rates, but we have a number of measures, none that are hard and fast other than that. We look at return on invested capital. We look at return on equity. We have boards that, board of directors, professional board of directors that ask that question, what is the right metric? And we don't have one, it's many. And again, because of our nature, we're heavily invested in plant and equipment, so return on invested capital isn't necessarily the best metric we can use, although in some of our newer investments, which are less capital focused, we'll use that as a metric. So there's any number of places. It's again hard for us as a private company to measure because looking in the mirror and trying to compare ourselves as we do to some of our public competitors, we've got to reach for something. So we're constantly comparing ourselves in some of the more ubiquitous metrics that they might use as well.
Okay. David?
I just say, we always wish we had more growth capital. We got to segment into different categories. There's some things, safety, we've got safety capital. We've got regulatory requirements that we're just going to have to make those investments to do the right thing within each market segment. But all of ours then to say we've got so much that you're going to go around and wish we had more dollars available for our growth capital. But other things are these are things we have to do as a business. And, again, as I started talking about earlier today, you've got timelines that we got to take and measure those against the amount of growth capital that we're going to put to work.
Professor Moss-Cantor mentioned an example of companies that sometimes feel pressure to meet their short-term financial targets, by cutting marketing or R&D during the year so they can meet their targets. How do you do you deal with that? How do you deal with that? How do you manage those kinds of conflicting demands between sort of meeting the short-term targets and still wanting to invest for the longer term? David, you want to start with that?
No. Yeah, I think we're and everybody's going to go through those cycles where you've got we had the conversations about how your culture is going to handle the great times and how you're going to handle it, when it's tough. And I think the big decisions you have to make is that you have to stick to your principles and take care of the right things, even when things aren't going as great. And there's just certain things that I think we all have certain parts of our budget and our expenses that we can manage, but certain things like safety, certain things like quality, certain things like getting the right training done within your plants. If you don't stick to your guns, you're never going to get to the good part of your financial performance if you don't stick to your principles in the right times and in the right places.
Mm-hmm. Brian, would you want to take that?
Well, I think that, and maybe just to finish the comment from before, the ultimate metric for us is growing cash flows over time. That at the end of the day is what we're compensated for. That's the value that is very real and very transparent to our shareholder group. What was the second part of the question that you asked?
So how do you make those? Do you ever have to make those trade-offs? And if you do, sort of, how have you, in a situation, how have you made a trade-off between, let's say, making those sort of expenditures on safety and other versus meeting your short-term financial targets?
Well, I agree with David. I think safety is our primary concern, right, and above all else. And I think we've come to find that there's a correlation between safety and performance and ultimately value. And that's very much ingrained in our culture.
Great. One of the topics that we've been talking about with the Sustainability Award for Mercon and in some of the earlier conversations was, and I was impressed by the fact that a lot of these sustainability initiatives seem to be win-win propositions, right? How does sustainability enter into your business model? And do you see the same kind of thing? And let me start with Ray at the end, because clearly you're in the timber business, right? You've got a certain amount of land, and if you're not sustaining that, then you're not going to be in business. So how do you think about that and the trade-offs?
It's real simple. In my business, sustainability is a condition of employment. Mm-hmm. I've known that since the first day I came to Deltic Timber. And in a natural resources company, through good times and bad times, the temptation is always there to abuse the asset or to take advantage of the balance sheet. And you have to have a culture, and you have to be willing to explain good and bad, right and wrong, and take your medicine when it comes rather than cover it up, hide it, or do the wrong thing to the asset or the balance sheet. Mm-hmm. So it's just, you do the right thing and you'll always come out winner.
And how do you convey that throughout the organization? Or is it, I mean, you've been, this is a business that's been doing this for a long time, so how does that culture get embedded throughout the organization?
Well, you might not have picked up, but I'm a pretty straightforward fellow, and condition of employment's understood.
So,
It's straightforward.
okay.
And it's that simple in our business.
Yes. And what about Brian, your situation?
I mean, very much the same situation. Again, two of our most important suppliers are our financial partners, some in this room, and obviously the farmers, who represent 75% or so of our cost of goods. So we better darn well pay attention to the issues that are important to them, and because they're the same things that are important to us. So it's all of the things that I'm sure were mentioned today, we're very aware of, and the nature of deteriorating natural resources has a bottom line impact on us. So it's hugely important. And again, to mention something that Dr. Cantor said, the way that we sustain ourselves is with attracting better and better people all the time. And it isn't just the millennials that have sustainability at the top of their focus, but within the last 2 weeks, we've interviewed a couple of very, very, very bright young people. And it was the first question that they asked, talking about values of the company, and values to them were all about sustainability. So there's a practical effect, I think, that if we want to get better, we've got to pay attention and make sure that our interests are aligned with the next generation of folks.
Okay. David, your company is a lot about innovation as well in terms of new products and things like that. How does sustainability fit into your sort of strategy and the way you create value, and do they work together? Do they fit together?
Yeah, they fit very well together for us. And for those that aren't familiar, we'll have trucks going up and down the road, and we're constantly looking for opportunities to concentrate products further so that we're running less. And a lot of times that's leading us to new innovation. I like to characterize our business when I'm talking to our bankers. I use the oil analogy, where we've got Easy Oil, and to us that's a cheese plant right down the road from our whey plant. And then we've got shale, which are suppliers that are a lot further away. And through the use of technology, we're able to bring these plants a lot closer together and expand our supply base, but also do it efficiently, do it responsibly, and make sure that we're not putting any undue pressure. When I look at it, sustainability is a big term, but from that perspective, it's on the environment. The other one for us is just trying to do other things. We use a lot of technologies to polish water, so we use less within all of our processing facilities. That's an element of innovation that I think throughout the organization, our people wear with a badge of honor.
Mick, given the nature of your business and the global operations and the fact that you're the middleman in a lot of things, is sustainability something that your business is involved in as well? And how does that relate to value creation?
It's very important, first and most fundamentally, in the sense of our participation, along with many of our peers and friends in this room, in what's really going to be a massive transformation in the agricultural and food space. Over the next 35 to 40 years, food production almost has to double to keep up with the current trends. We're going to produce as much food in 40 years as we did in the previous 8,000 years. I'm quoting the WWF here, so how that math fits together, that's there. Those are their data, but obviously because of changing food consumption patterns in emerging markets in particular, the demand is rising rapidly, and our role is that we see as crucial. We are investing in debottlenecking, in improving access to agricultural goods in places like the Mid-South in the United States, and helping facilitate more efficient movement of goods from what will increasingly be a surplus to deficit type trade. Many nations like China have taken tremendous strides to improve productivity and yields, production. but clearly facing the inevitable increase of commodities, of which food commodities are a big part. So we will see increased trade, and we intend to participate that in a very productive way from an investment and sustainability point of view.
Are there any specific sort of sustainability things that any of you have done that would you want to think would be worth mentioning that would be able to sort of show how the two fit together? Ray, you wanted to say something?
Yeah, sustainability is a broad subject. Okay, so my next question is verification. Okay, at Deltic Timber, our 530,000 acres of timberland is third-party certified by the Sustainable Forestry Initiative every year on every principle in every district, forestry district that we have. So it's not real unless you measure it, and unless you measure it frequently, in my opinion.
And is that that's a voluntary certification?
Strictly voluntary.
Yes.
But it's powerful whenever I can tell an investor that we can harvest over 600,000 tons of pine saw timber a year forever, because that's biological growth. Mm-hmm. That's powerful. Mm-hmm. And prove it with the assumptions that it's built with assumptions, but they're reasonable assumptions.
Right. And you find the buyers are interested in that?
I wouldn't go that far yet.
Okay.
Investors are.
Pardon me?
Investors are.
Investors are.
Investors are, but not necessarily the people buying the lumber products.
Right. Okay.
So.
Okay. Good.
We've made investments and big bets on organics for the last number of years, not just because we think it's a growing trend, which it is, but also because of the limited use of pesticides, insecticides, and what have you, as a quick example. We're also working hard with the breeders on the wheat side for more drought-resistant kinds of crops to recognize and take advantage of what we think is the inevitable loss of more and more water.
How does that, could you explain how in your role as a miller that your role can contribute to that?
Well, I mean, we're part of a larger chain, as everybody is, of value, and we're, as a private company, partnering up and down that chain as best we can. We think it's a way to differentiate ourselves and control our supply all the way down to the consumer.
And what's the driver? Is it consumer-driven, or do you think there are other things driving this as well?
Say that again?
Is this all consumer-driven, or is it driven by other factors as well?
Well, of course, at the end of the day, it's driven by consumers, but by the same token, I just think it's a competitive advantage to, and because of the constraints of the company being private, we have no real choice but to partner up and down that chain as best we can. So there's a number of strategic reasons and customer reasons at the end of the day.
Mm-hmm. Okay, good. Let me go back to in the beginning, and I'm going to sort of challenge you a little bit on this one to describe one of the more difficult decisions that you've had to make when it came to sort of trading off sort of value creation and some other thing that you felt was important, whether it was pressure for the short term or sustainability, and how did you make that decision? You don't have to go into any kind of the details, but sort of just some of the thinking that you went through. Any volunteers on how to start with that? Ray, you're willing to?
The way I would characterize it is you never put the balance sheet in a situation that you think you have to do anything. My previous career was with a company that was bankrupted twice, with the CEO with a have-to-grow mentality. Mm-hmm. And so when you put that constraint into the decision-making process, then in most cases the numbers don't mean anything. Mm-hmm. Because anybody that believes the market's going to save you, that's the first fallacy in the assumptions. Mm-hmm. So I would say it's in my world, being public, and I have to confess my sins quarterly and tell the truth about them. Mm-hmm. And then everybody knows, the truth. Mm-hmm. And so that's a big difference in the amount of risk you're willing to take. Mm-hmm. And do you really believe your assumptions in that value creation opportunity?
And how do you, and given the sort of the the fact that your business is somewhat limited by the amount of acreage that you're able to harvest at any point in time. How do you grow and create value at the same time in that business?
Well, same thing that most of you are doing in the room, but it's silvicultural practices, making the dirt more productive, okay? And and that means investing more in it, whether it's through fertilization or through bedding or tilling practices. So you're investing more and you're growing more per acre, whether it's corn or whether it's a pine tree. We're growing more pine trees per acre. And then constantly developing the seed source to grow taller trees faster with fewer limbs and stronger. And so it's technology-based and it's constant.
I like the idea of fewer limbs. Never thought about that before.
Fewer limbs, fewer knots.
Yes.
Okay? Everywhere there's a limb, there's a knot. That's a defect.
Yeah.
Okay? It's a downgrade. Lowers value. Lowers value. Okay?
So you want a tree that goes straight up without it.
In our world, we call it gun barrel straight and bowling ball round. That's the perfect tree.
Okay. David, what about you?
You know, I think all of us, if you're dealing with the agricultural commodities, we see some of the swings. I always say, we got to keep our ear really close to the ground. Our markets can be impacted by the amount of rainfall on the South Island of New Zealand, and whether what's the growth rate or import demand for milk powders going into China, and that can have a big impact on our business. So I think as we've seen some major shifts in commodities, and I think everybody in agriculture are going to see those, there's times, and I'll use the description where we've got to keep one foot on the brake and one foot on the gas to whether how aggressively we're going to go after some of our growth capital or innovation capital items until we can see some markets settle down. We ran into those, and I think a lot of people have. But those are scenarios that you can't foresee. We get great support from a lot of people trying to analyze what's going to happen in these markets, but ultimately we've got to wake up every day, and at times you can't get enough information about what's going on in your business, in your markets, to help you make those right decisions going forward. So I think those would be examples where we've kind of had to say, how aggressively can we move towards a new technology and something that we're excited about until we really see the direction certain markets are going to move.
Okay. Mick, did you want to comment on any sort of difficult sort of situations you face that you have to sort of make those difficult trade-offs?
Coming back to one of my earlier comments, which was the right balance of diversification, that which has served us quite well through some of the volatility and cyclicality we've seen over the past 7-8 years in particular, that as if most divisions do well, if one or two do less well, then we still do well in aggregate. But at some point you have to take the hard choice on those divisions which underperform, and we've had a couple of those over the past, certainly in my lifetime, such as rubber 4 years ago, where we did not sort of reach that and achieve that critical mass and leadership and momentum to really consider it one of our core divisions. So those are some of the discussions we have every year.
Mm-hmm. One of the things that Professor Moskander mentioned was the difficulty of creating value from acquisitions. If any of you sort of, I think we had one comment on it earlier, I'm sure you have bankers coming to you all the time with ideas, maybe some in this room. How do you think about those? Have you been successful with them? What do you look for? Those kind of things.
I would just say it's extremely hard. There's normally a wide spread between the bid and the ask. If you've got a mentality you have to grow or you have to do something, you're going to overpay for it. It's very, very difficult to ever dig your way out of that hole. That's why most of them don't work. Mm-hmm. Then you put the cultural aspect and trying to, there's no win-wins in those. You either are acquired or you're the acquirer. Mm-hmm. And there's a big difference. I've been on both sides. Mm-hmm. so it's hard to explain how it's a win-win in that case, because you've overpaid and then the returns and the numbers don't work in a lot of cases. unless you just happen to hit the market at the right time.
David, as a private equity held company, how do you think about acquisitions? Have you done some?
Yeah, we made a lot of asset-based acquisitions, and I think the key thing going in is trying to understand how do we take 1 + 1 makes 4. How does 1 + 1 exceed our expectations, and make sure that we've got some synergies going in, and generally try to make sure we're not trying to pioneer something that we don't have a great familiarity, whether it's some market intimacy, listen closely to what our customers are going to need so that we've got demand for a new acquisition. And most of our growth, as I say, primarily been organic, has been trying to get the right asset and allowing us to put our technology, our toolkit within the 4 walls. And so the integration element maybe has been somewhat different because we've just needed more production capability, and that's what's been driving the primary base of our investments. I don't think over the last recent couple of years, the integration of a culture, and I've been a part of it, to your point, I've been acquired before by a much different culture. Those are big challenges to take on because we've got to marry everybody's final result and get everybody focused and going in the same directions. Those are some of the biggest challenges that you're going to face with bringing that on. But on the flip side, we've also done it with bringing new facilities into our fold, new management teams, and to blend them in. And when you get that victory, there's nothing better.
Okay. Brian or Mick, any comments on that one?
Well, for most of our history, we've been driven by our own internal growth. So we're relatively new to acquisitions. We've done a couple in the last 3 years, and I think we're trying to figure out as we go along how to measure the increased value that it brings. Other than the obvious ones where we can buy the cash flows that we project, we're trying to understand better our own internal metrics, new customers that come from that, the additional attributes that go back to our core business from those acquisitions and things of that ilk. So we're learning is the best way we can, I think successfully so far as well.
Good, thank you. We do have a couple minutes for questions. If anybody would like to ask questions, or I don't know if there's any questions from the app, but any questions for this group at the very end of the day here?
Thank you. Both Brian and Ryan mentioned the importance of metrics to measure what you're doing and to develop these key performance indicators in your organization. Professor Cantor also mentioned the importance of metrics in Continental Airlines to motivate the human resources. How do you operationalize the use of metrics as a value for your organization so that they can understand what the goal is for your organization?
I tie them directly to their financial rewards. And it's real simple. Here are the metrics. Here's what we invested in. Here's why. And we either attain it or we don't get paid. That's all of us, me included. So we all have the same metrics. We're all measured the same. So
what are some of those metrics? In addition to the financial one, are there non-financial metrics that you use?
Oh, sure. It's when you get to the operating level, it's the measurement of productivity, yield. When you've bought, quote, a new scanning system that's you spent $2 million on it, here's the justification for it. Do you achieve it, and how do you measure it? We at Deltic Timber start measuring at the first day of operation. Mm-hmm. When it's put in operation, we start measuring it the first day, review it every month. Mm-hmm. And their bonus is the production unit, the management of that unit, and the executives associated with it will be tied to that same metric. Mm-hmm. And so basically, if you perform, you get paid.
But so for example, one side of the business that's responsible for the productivity of the land itself maybe have a different set of metrics than the operating, side who are cutting down the trees and converting them, that kind of stuff.
That's correct. Yeah. And it's very hard to measure how fast a tree grows. You can watch it all day long. You better take your knapsack.
And you can count the limbs, though.
That's right. So, and in forestry, I mean, you've got a 30 to 40 year harvest cycle. Okay, and most foresters never are around to be accountable for the decisions that they made 30 years ago. So you have to know who you're going to bat with, and you have to trust them, because there's a lot of trust built into the business. But trees are great employees. They work all day and they never complain.
I think that from our perspective, the metrics are driven primarily as a reward for our management and ultimately our ownership, and it's driven by cash flows over time because of the peculiarities of our cyclical business. But we look at some of these newer acquisitions that I mentioned before with other metrics in mind. It's the contribution that they make to the bottom line, not necessarily the profit. It's the amount of new customers that come from those kinds of opportunities, and at the end of the day, when we do come time to pay out both for short-term and long-term incentives, those incentives are driven in part by both of those equations, depending on more driven toward the cash flows, but the others are equally important for the longer term.
Okay. Well, now that it's the end of the day, I think that I wanted to thank the panelists here, and I certainly enjoyed the conversation. I hope you did too. And turn it back to Paul.